Good morning, everybody. It's a real honor to be part of this event today. Congratulations, Julia, on bringing such a rich program together. And I've really enjoyed hearing the first hour and the discussion that you've just had there with James. I'll actually be picking up on some of the themes that you've been discussing with James in my remarks for the next 20 minutes or so. So as you mentioned, Julia, a year ago, my colleague Richard Monks addressed this conference on the topic of trust in sustainable investments. And he flagged some of the issues that we'd identified in our work, notably around data gaps, difficulties in navigating a complex and changing product landscape, and issues such as patchy performance measurement and challenging descriptions of products and performance. And he also talked about some of the work that we were really embarking on at the FCA to improve transparency and improve trust and start tackling some of those issues. This included our work to develop the guiding principles, which you just mentioned there, and also the work that we were doing to implement TCFD aligned disclosures across listed companies and regulated firms. Harold Wilson once mused, a week is a long time in politics. Well, it's an absolute age in ESG regulation. And we've reached a number of important milestones in our work over the past few months, particularly in those areas of transparency and trust. Just like to give a few of the highlights here. So as you mentioned, we finalized our guiding principles, and these were issued alongside a Dear Chair letter to authorised fund managers back in July. And some of you may have seen an excellent article in Forbes just last week by Bob Eccles that was talking about these guiding principles. They clarify our expectations for the design, delivery and disclosure of retail responsible and sustainable funds, both as applications are submitted to us for authorisation of funds and on an ongoing basis in relation to existing products. We want to see a significant improvement in the quality of the applications that we receive. And we believe that if firms apply our principles rigorously and robustly, we think consumers will be better able to make informed decisions and better able to purchase products that meet their needs and preferences. Second highlight is the fact that we completed the first phase of our implementation of TCFD aligned climate related disclosure rules. These were for premium listed companies. We recently consulted on the second phase, and we're proposing similar rules for a wider scope of listed issuers, as well as clients and consumer facing climate related disclosures for asset managers and FCA regulated asset owners. And then a third highlight, I think, is the work that we've been doing with our international partners to drive progress towards an International Sustainability Standards Board, ISSB. This will set common global baseline standards for corporate reporting on sustainability. And a year ago, the IFRS Foundation, which is looking to launch this new board, had only just opened its consultation process, gathering views on the potential role it could play in sustainability reporting. Now, just a month out from COP26, we're on the verge of the ISSB becoming a reality. And this is a potential game changer for transparency on companies' ESG performance. It will support not only better decision-making across the market, but really improve that information flow from the corporate sector right along the investment chain and ultimately to the end consumer, really enabling so much more to be done in the market for sustainable finance and really enabling verification of claims that are being made at each point in that investment chain. I would also note that alongside these various key policy initiatives, we've been enhancing our own internal arrangements. We've been taking initial steps to embed ESG across the organisation. I think James and Julia both mentioned that we've hired our first ESG director Sasha Sedan, who's joined us from Legal and General Investment Management, where he was Director of Stewardship. And he has a strong mandate to really look across the breadth of our regulatory functions and see how we are implementing and embedding ESG within them. And the work that we're doing on embedding is consistent with the net zero have regard in our remit that James mentioned in his remarks. We're aiming to ensure that as an organization, we walk the walk. So not only are we looking at how we embed ESG in our regulation of listed companies and financial services firms, but also how we operate as an entity. And in that regard, we're aiming to publish our own TCFD report in 2022. But while we've made good progress in many of these areas, in some ways our task has just got bigger. 2020 was a bumper year for ESG investing. According to Morningstar, 2020 saw record investment of more than 200 billion into European sustainable retail investment products, almost double the figure in 2019. And as the market has grown, so have the concerns about greenwashing and exaggerated claims. And of course, Julia and James both talked about this very, very critical issue. We've all seen the media headlines. We've heard some of the inside stories on certain firms' practices. And quite frankly, these threaten to undermine trust in the market, leaving investors disillusioned and potentially turning off the flow of much needed capital to sustainable projects and activities. So it's a very, very serious issue. And that's why building trust and improving transparency remain such important cornerstones of our work in this area. So for the remainder of my talk, I'd just like to discuss 3 actions that we're taking looking forward to do more to build trust in this market. First of all, we'll follow up on our guiding principles. So the guiding principles really help to set our expectations for new ESG-oriented funds as they come to us at the authorizations gateway and on an ongoing basis. In the authorizations process, the guiding principles will help us assess whether the fund has undergone a robust product design and whether its name, its objectives, its strategy are appropriate, coherent, and consistent and reflected clearly in fund documentation and disclosures. They'll also help us consider how the applicant fund plans to deliver on its strategy and objectives, as well as how that approach is reflected in a model portfolio of holdings, and how well that model portfolio would meet a reasonable investor's expectations. Some of those expectations gap issues that Julia talked about just a few moments ago. And then the guiding principles will also be relevant in our ongoing supervision. We expect firms to be considering these to assess whether their existing ESG-oriented funds would meet our expectations. So for those of you out there running funds, we really do encourage you to look carefully at your product design and delivery processes and satisfy yourselves that they are aligned with the expectations in our guiding principles and that you can stand behind the claims that you're making. And then you may also need to build in additional challenge points into your governance processes and make sure that incentives are right at every level. And then for those of you who are advisors, you may need to do more to scrutinize and challenge the products that you're giving advice on and really interrogate both consumers' needs and how well they're being met. So looking at all of this, we continue to develop our supervisory approach in what is a very dynamic and evolving space. We're going to continue to follow up with firms where we observe activity that we feel falls short of our expectations in the areas of design, delivery, and disclosure of their ESG products. And we may also carry out thematic reviews as the guiding principles and other initiatives embed, allowing us to take stock of the sector to determine whether further work or follow-up action is required. So firms should really expect closer scrutiny. A few relevant questions for fund managers would be, do you have the resources you need to deliver on your ESG promises, including the technical skills, the data and the tools? Are you confident that you continue to meet your objectives, your policies and your strategies, and that these would be aligned with investors' expectations. Do your pre-contractual disclosures fairly state and not overstate the ESG focus of your fund? And do your ongoing disclosures about performance against target ESG characteristics actually deliver the information that consumers need in order to monitor whether their expectations are being met? So these are all really, really core questions, I think, and will be important as we continue to monitor and supervise the sector in relation to these products. Let me turn now to disclosures, labels, and product classification, another really important area that Julia and James were talking about earlier. So importantly, the guiding principles that I've just mentioned are an authorization and supervisory-led approach that is grounded in our existing rules. We consider them a starting point, not an end point for our work in this area. And building on these, by the end of the year, we're going to be looking to have finalized mandatory disclosure requirements for asset managers and FCA regulated asset owners to make climate related disclosures. We consulted on these, as I mentioned, over the course of the summer. Those consultations closed just around a month ago now, and we'll be looking to finalize our policy position by the end of the year. Under our proposals, asset managers, life insurers, and FCA regulated pension providers will be required to publish annually an entity level TCFD aligned climate disclosures report, setting out how they're taking climate related matters into account in managing their investments on behalf of clients and consumers. And firms will also be required to publish annually a core baseline set of product and portfolio level disclosures that include metrics related to scope 1, 2, and 3 emissions and the product's carbon footprint. Now, these disclosures aligned with TCFD will sit at the core of new whole of economy sustainability related disclosures, which the Chancellor announced back in July at his Mansion House speech that he would be working towards. And the government plans shortly to publish a roadmap that sets out how those Mansion House ambitions will be delivered and the roles that will be played by various of the government departments and regulators, including the FCA. The disclosures regime will be complemented by sustainable investment labels, another part of that Mansion House announcement. And the aim of these would be to help consumers navigate this complex landscape of ESG focused products. And recognizing the critical intermediary role that advisors play, the roadmap will also set out steps towards introducing specific requirements for financial advisors with a particular focus on how advisors assess consumers' needs to ensure the suitability of products. So a significant part of this roadmap will be delivered through FCA rules. We'll be responsible for asset managers' disclosures, we'll be responsible for the labeling regime. So given that, in the next few weeks, we plan to publish a discussion paper which will seek feedback on the shape of the regime ahead of consultation next year. As part of this, we'll present our initial thinking on key design features of a product classification and labeling regime. And I'm just going to talk through some of these key features just at a very high level, but in so doing, I'll touch on a couple of the matters that Julia and James were discussing in the area of stewardship. So first key design feature is that we think consumers would be best served by labels that apply clear definitions and criteria to group funds into a small number of categories across the full spectrum of product types, all the way from those that do not actively promote sustainability themes or characteristics to those that progressively integrate ESG considerations, influence ESG outcomes, for instance, through stewardship, or pursue sustainability themes, characteristics, or objectives. And then right at the end of the spectrum, those that aim to and claim to have a positive real world impact. We really do favour objective and descriptive labels rather than those that would make value judgments as to what is good or what is bad. A second key design feature that we'll be looking for feedback on is that we think the regime should classify products based on both their sustainability characteristics, themes or objectives, and how these are being pursued, and the proportion of their investments that are already allocated to sustainable products or activities, as defined, for instance, by the UK taxonomy, prospective UK taxonomy in relation to climate mitigation and adaptation. And we think that the classification regime should also take into account, perhaps in terms of entry level or gateway criteria, firm level attributes of the fund manager and how these are reflected in the design and delivery of its products. This includes matters such as its governance of ESG and its demonstrated commitment to responsible or sustainable investment. And as James said earlier, investors can be a real force for good by encouraging companies to improve their ESG performance, for instance, through active investor stewardship. And I strongly agree with James's remarks that a divestment strategy without active stewardship to influence and drive transition essentially would be passing ownership from those that care to those that don't. And that is not what is going to deliver an effective transition. So if a classification and labeling regime didn't take these matters into account and only classified funds based on the extent to which they were already invested in sustainable products or activities, we worry that it would fail to capture intentionality and it would fail to recognize the role that investors can have in driving positive change. So that's why we feel that the labeling and classification regime should take both allocation and intention into account. Third key feature that I'd just like to mention is that we think it's really important that a regime applies terminology that is already familiar to both investors and industry, and that it leverages existing and ongoing work by industry participants. And in the context of disclosure and labeling regime, this would include work by trade associations such as the Investment Association and TISA and UK CIF, as well as the CFA work underway by the CFA Institute on ESG disclosures, by the British Standards Institution on its sustainable finance program. And we should also make sure that there's coherence with the EU's SFDR. We're going to do all we can to work hard to ensure that consumer-facing communications under the regime are accessible and decision useful. We're going to look to design consumer-facing product-level disclosures that provide standardized information on the key sustainability attributes of products, with an aim to help consumers compare similar products and evaluate sustainability claims as effectively as possible. The design of both the disclosures and the labels will be informed by a second phase of consumer behavioural experiments that we're planning to carry out at the FCA in late this year and early next. And this will build on initial research around how consumers make their investment choices in this space that was published back in July. And once the new disclosure and labelling regime is in place, we really do expect firms to apply it carefully and think hard about the clarity and consistency of their messages, and think hard about the effectiveness of the governance, the systems and the controls that they put in place to classify their products. And finally, think hard about how well they're helping consumers understand the intent and the ongoing performance of their products. So a really important body of work there that's going to be with us for some time. And we've already had some fantastic discussions with stakeholders, including Julia, including James, about this, and look forward to further dialogue once we've published our discussion paper. The third area that I wanted to touch on in my remarks is the wider ESG ecosystem. So as industry participants more fully integrate ESG into their activities, and expand their ESG focused product offerings, they're increasingly reliant on third-party ESG data services, as well as ESG ratings and benchmark indices. It's therefore increasingly important that these services are delivered in a fair and effective and a transparent way. Of course, as we all know, ESG matters are by their nature wide-ranging and complex. And as a result, each data, ratings, or benchmark provider makes different choices about which ESG factors to consider in its methodology, how to weigh them, and which metrics to use to measure performance. In the case of ESG ratings, this results in the well-publicized low correlation between different providers' ratings. As a result, without good transparency around what goes into methodologies, it may be quite difficult to interpret and compare outputs across providers. And without the ability to interpret properly and really understand what the ratings mean, this can potentially lead to harms ultimately for consumers. So we've been looking at this quite hard. We recently participated in international work on this issue with the International Organization of Securities Commissions. We also considered these topics in a discussion chapter in one of our recent TCFD consultations. In particular, we called for feedback on whether there's a case for regulatory intervention in this space, including on matters such as governance, conflicts management, transparency, and systems and controls. So that was part of one of the consultations that closed just last month. We're currently analysing responses and we'll be feeding back on this in the first half of next year. We're also going to consider further our role in supporting other enhancements in the ecosystem for ESG. For instance, we're actively engaged in industry dialogue on matters such as voluntary carbon markets, ESG in derivatives and securities lending markets, and responsible sourcing in commodity derivatives. But irrespective of further regulatory intervention in any of these areas, as users of ESG ecosystem services, we believe that you all have a really important role to play in imposing discipline on providers across the ESG ecosystem, exercising careful due diligence, and challenging providers on their governance arrangements and methodologies. Ultimately, it's going to be really critical to make progress in this area. And one aspect that we are looking at the FCA is innovation in ESG data and disclosure, and what can be done to improve verification, what can be done to improve the quality and the availability and accessibility of data, and potentially in future the machine readability of these data. And as a first step, we'll be running a tech sprint later this month, which is really designed to explore some of these ESG data and disclosure issues from the perspective of effective regulation in this area. And then we've also been inviting applications to join a second pilot digital sandbox, which again will be focused on ESG data and disclosure. And we encourage anybody to engage with those initiatives, which we think can really help to build creativity and drive innovation in this critical and growing area. Just before I close, I'd just like to say a few words about how we're organising ourselves more broadly and our wider strategy in this area, because I've focused quite narrowly here on trust and transparency. Ultimately, in such a fast evolving space, our strategy in ESG related matters continues to develop. I've already talked about the arrival of Sasha Sedan, and with his arrival, we are looking shortly to publish a refreshed ESG strategy. We've not published a strategic document since late 2019, so 2 years on, and particularly with all that has developed in this space, we're planning to set out more widely how we're building from our existing priorities and commitments to expand and deepen our strategic approach in this area. Trust and transparency will, of course, remain core themes, and I've just talked about some of the key elements we're going to continue to look at there. But we'll also be setting out actions we propose to take to support a market-led transition to a more sustainable future, with the transition to net zero being a key part of that. And as mentioned earlier, we'll describe the extensive work that we're carrying out internally to ensure that we have the right organisational structures, resources and capabilities in place to appropriately embed net zero and ESG considerations across the FCA. So we look forward to continuing our dialogue with industry, with relevant trade associations, with Julia, with James, as we continue to evolve and deliver that ESG strategy. So thank you very much for your attention. I'll hand back to Julia now. Thank you very much.
Mark, thank you very much. That was a great run through of all the many things that we've been discussing and the things I know you're working on. And I know there's so many pressures on your time, because we all now seem to recognise that this is incredibly urgent. Now, there's quite a lot of questions in the chat box, in the question area. We've got ones from Annie Giavelli, Jill Turner, Mark Crofts and Alex Reynolds. Some of them are focusing on things like there's one on monitoring intentionality. There's another one on the support you're giving intermediaries, and concerns about what this means for advice. Obviously, can people be criticised retrospectively for not having got this all right in the past? And there's a question also on UK regulation and taxonomy, how that's going to be different from the EU taxonomy. I don't know if you'd like to say a few words, but I will cut you off I want to cut this off. Let's not say necessarily exactly bang on 11:30, but say in about 1 or 2 minutes. And can I first say, if I send them all to you, would you be able to reply? You're on mute.
Yeah. So yes, maybe that's the better way to do it. If you send them on, we'll take a look and provide written responses given the time. But is there a particular question that you'd like me to say a few words on right now?
Let's say, so actually I've gone back to it. So Mark's question earlier, so guidance from the FCA on standardized definitions and this whole kind of getting things right bit. You touched on that briefly. Do you want to say a little bit more on that?
Sure. No, absolutely. So ultimately, and I did touch on this a little bit as one of the sort of key design features as we work through product classification and labeling, we want to build on accepted terminology. Now, there is a general confusion in the marketplace. There are a lot of terms that are used quite interchangeably. And I think what we ultimately need to do is to land on some very, very clear definitions that that then drive our classification and labeling regime. But we don't want to do this alone. We need to do this in collaboration with industry. We need to do this building on the various different initiatives that are already underway in this space. The British Standards Institution, which Julia mentioned earlier, has a established sustainable finance standards program underway that will be looking in its next phase at product level standards. And it has already established specifications for responsible and sustainable investment, which includes some very helpful definitions that can be leveraged here. But equally, we can't be looking at this solely in the UK either. And that's why we're so very strongly engaged with work under the International Organization for Securities Commissions, who published a consultation paper back at the start of the summer, which included draft recommendations that promoted asset manager disclosures consistent with TCFD, and also identified key elements of product level disclosures that could usefully be harmonized and standardized internationally. So there's a lot of work to do to land on key definitions, land on the key elements of disclosure regimes to ensure that there's consistency and coherence. And of course, we can't forget as well that we are we'll be making rules in this space for many firms who are already subject to EU rules under SFDR. And as a result of that, we need to ensure that there's a level of coherence between the regime that we introduce in the UK and that in the EU. Thank you.
These things are properly international. There's no point us all pulling in different directions. Mark, I'm going to say thank you very much at this stage. And for those who put questions in the chat, Zoom does catch all of this stuff. I will respond to what I can, but basically I will get the whole lot across to Mark, and we will circulate something after this event. Mark, I know that you are effectively juggling about 50 things at once in this area, and we've got comments in the chat also about, you know, this is urgent, we've got to plow on. Yeah, we know this, we get this, and I know from my conversations with Mark that Mark gets it too, but it's also got to be right, because we've got so many challenges around people misunderstanding things, greenwash, concerns about taxonomies, etc., that this has all got to make sense coming together. So I've been pushing for change in this area with regulators for so long, but I really would say, you know, doing things too fast at this stage would be a mistake. So I welcome what Mark is doing wholeheartedly, and you will continue to have certainly my full support and full access to everything that we gather, so that you can hopefully make this be as successful as possible going forwards. So with that, Mark, thank you. I'll let you go. That's absolutely brilliant. Really appreciate you spending the time with us. That was just great. Thank you so much.